So good afternoon, everybody. Welcome to our webinar this month. It's obviously the second last day of August. It's amazing where this year's gone. But anyway, the whole idea is that August is National Women's Month. As I say, we're the second last month of the month already. But the whole idea is that we celebrated and appreciated the resilience and strength and the courage of women in our society and reflect on our nation's progress and obviously the journey towards gender equality. So studies have shown that behavior in relation to investing and saving has traditionally differed between women and men, and women generally have been more likely to save and less likely to invest, but also more likely to hold a lower percentage of risky assets in their portfolios, with the result that they were more likely to have lower retirement income than men. So that was traditionally in the past. We're seeing these things, the pattern is changing, with more and more women obviously investing outside of their retirement plans and also starting to invest earlier than before. So good afternoon, everybody. My name is Sean van den Berg. I'm an investment specialist at PSG Wealth. My objective today is to discuss these traditional differences, but also more importantly is for the men and women to learn from each other, and the whole idea is to achieve better investment success. So just quickly look at the agenda or our topics for discussion. Whoops, wrong button. Here's my little agenda. Very briefly, we're going over very quickly, why women should be more confident about the investing and what we can learn from women and the investment behavior. And I want to spend some time on those investment strategies. Okay, so just to kick it off quickly, give you some context. I think when you think about investing, you probably have a stereotypical view. When I say stereotypical, it's just a fixed general idea that a lot of people have about a thing that may be false in many cases. So that's what I mean by stereotypical. So if I say Wolf of Wall Street, some of you might have seen the movie, but you'll have this image of a lot of men yelling in suits, and obviously that's because through the decades, it's typically men taking up the investment space. The equity analysts, the share experts, the traders, the shareholders, the board chairman, directors, and obviously finance experts. As I said just now, but slowly but surely, women obviously are increasingly holding positions in the finance world. But in reality, it's men that are making the discussion posts and constitute 90% of participants in most share-related groups on social media. So yet, despite that, the men taking up the investment space, numerous studies reveal that some empowering truths for women out there, that men, sorry, I didn't through the cat amongst the pigeons there, that women are in fact better investors. Okay, so just to kick off, to make everybody feel good, let's look at 10 reasons why we should be more confident, why women should be more confident when investing. So it's obviously self-explanatory. Financial independence, investing allows women to build wealth and achieve financial independence. It helps them feel obviously secure in their future and giving them freedom to make choices without relying on others. That's number one. And number two, investing provides the opportunity for long-term growth of wealth. So investing in assets such as shares and obviously property, women can potentially earn higher returns over time compared to putting your money traditionally in a savings account. Also, very importantly, is closing that gender wealth gap. Historically, women have lagged men in terms of wealth accumulation. By investing, women can close that wealth gap and work towards achieving financial parity with men. And it also, and this is obviously one of the main reasons for me having a webinar like this, is to increase financial literacy. So investing promotes financial education and literacy. Okay, so by delving into the world of investments, women can, and in this presentation, I've got links to some, a list of books and books and websites So you can learn more about or gain more valuable skills and things like that about managing your finances and making better investment decisions as such. And then lastly, there on this page, diversification. Investing enables women to diversify their portfolios and reduce risk. That's the main idea. So obviously you want to spread your investments across various asset classes and industries. And the whole idea, as I say, is to reduce or mitigate the overall impact of losses, but also to enhance your overall returns. Those are the first 5. Let's look at the next 10. Sorry, next 5. Are we covering gender stereotypes? Obviously investing empowers women to challenge the gender stereotypes and break the notion that finance is solely a man's domain. By actively, obviously, participating in investment activities like this. You guys are on this webinar, so quite a few ladies on the webinar. You demonstrate your financial acumen and elevate your confidence. Retirement savings, we've touched on this before a lot of times. Obviously, it's crucial that you build up adequate or sufficient retirement savings, like a retirement annuity, by starting earlier. And past webinars we have touched on this quite a few times. By starting early and consistently investing, obviously you're going to secure a comfortable retirement, devoid of any financial worries. And then obviously passive income. You can invest in assets that like dividend paying shares or property that generate passive income streams. So we talk about alternative income sources. Apart from your job and having active income, is to have passive income. That be it portfolio income from shares, dividends, and rental income from rental property. Okay, so as I said, very self-explanatory. And also very importantly is that I believe is that last point there, inspiring future generations. You want to set the example. You want to empower the younger girls and women to take control of their finances. You want to foster a culture of financial independence, and also you want to inspire the young girls to pursue financial success. Okay, so just as it was a quick heads up reason why you can be more confident. So what can we all learn from women investors? So compare your investing style with these insights. Obviously, investing is all about independence and empowerment. That's both true for men and women, of course. But for women, they tend to live longer than men. Investing can provide a financial lifeline, especially as their healthcare costs will rise in retirement. So this, as I mentioned just now, several studies over the years have shown that women outperform men by an average of anywhere between 0.4, 40 basis points to 1.8% annually. Doesn't sound a lot, but if you compound that, it does make a big impact over the long term. Okay, so let's touch more about what we can learn from women. Again, as I say, self-explanatory. The main idea here is that there are likely reasons for this outperformance or these differences, but the whole idea is that we can all learn from it. Women tend to invest with goals in mind. Obviously, their family financial security is important to them. A child or a grandchild's education is important to them. Maybe saving towards a dream vacation or a first or second home. But the whole idea is that you want to have those goals in mind and then stay focused and stick to that goal. Okay. You can see there also, very importantly, they have diverse portfolios. The whole, I mentioned just now, the whole idea is to spread the risk, and women are very, very good at doing that. They're very, you'll see in the next slide, we talk about being risk averse. So they do favor a more of a balanced investment approach. So we're not tilted heavily towards just shares or bonds or a certain sector. They like a more balanced risk averse approach. So saying that you don't want to be too conservative, and cause you to miss out on potential returns over the longer term and things like that. So yeah, as I say, very self-explanatory. I'm going to go through this. It was very interesting to note that that when it comes to share portfolios, women are more buy and hold orientated than men, which are more actively involved. So women will create a buy and hold share portfolio. Obviously, the big advantage there, and part of those outperformance is they don't have all those niggling additional trading costs. Okay. What I was also very interesting to learn when I was doing my research on this, women are more likely to invest through a tax-free. So the idea here is that by investing in a tax-free investment plan account, the gains and income obviously are tax-free, and this is what appeals to women. So industry figures show that women open 20% fewer direct share trading accounts, 20% fewer. Okay, but then also, despite that figure, 65% of women invest into tax-free savings accounts, 65% compared to just 58% of men. So women are obviously making the most of those of this tax-efficient vehicle. And then also, very importantly, they ask questions. You know, they seek out information before investing. They drill down and want to understand what they're investing into and why they believe they must make the move. So that was also very, very important. So they tend to be more open to advice, either from a professional or through a financial mentor. Okay, and as we mentioned just now about cash, you know, many statistics show women have the money available to invest, but they prioritize cash savings. So 55% of women said they had never held an investment compared to 37% of women. However, there was a study completed by BlackRock that showed that 68% of non-investing women thought their future would look better if they did invest. So yeah, and then the very last point there, you know, as I mentioned just now, women live longer than men, so they have more time to invest. And that means they have more time to let the investments grow and to obviously take advantage of compound growth. So ladies, make longevity your best asset. Okay, so I have touched on this before, just reinforcing some of the stuff again. I believe that long-term perspective and risk aversion is important. Having a patient approach is also important. Doing your homework, but there's other little things that we can look at. You know, you can put a high value on these traits when making investment decisions. Thoughtfulness and discipline, very, very important. Curiosity, so just that whole idea about learning, I believe is important, the hows and the whys. And then obviously things like trust in people. So, you know, women do not overthink their strategy. They're more inclined to accept and follow advice once they have established trust with their advisor. Okay, so just reinforcing some of those points from earlier. I want to spend more time on this popular investment strategies. So obviously the whole idea here with investment strategies is not one size fits all. Everybody's different. What's important is obviously we all have personal circumstances, different time frames, and obviously different tolerance to risk. But the main idea here is choosing the right investment strategy is one of the most important financial decisions you as an investor can make. So there's, as I mentioned just now, there's no right investment strategy. It's different from person to person. But you know, the whole idea here, and why I wanted to highlight this was that you know, you can simplify things. There's some time-tested strategies you can follow as a starting point. But remember, the whole idea about having an investment strategy is you want to minimize your risk and optimize your potential returns. That's the whole thing. So it takes time for these strategies to work. So there's not a get-rich-quick scheme. I'm sorry, guys. Okay. So what's important when you begin investing is obviously having realistic expectations, what you can and what you can't achieve. But also imagine this, you know, if you're first starting out and if you could invest your savings, have someone else manage them wisely and professionally on your behalf, would you be interested? So the idea here is unit trusts is one way of looking at it. Unit trusts are professionally managed investment vehicles that pool money from different investors. They might seem scary at first, but they're great for for investing. Now, the main idea is, as I say, it's professionally managed by a fund manager, number one, and more importantly, you already got a diversified portfolio. Okay, so the three ways. Let me just grab some. Three ways you can make money from unit trusts. Well, basically two, but split them up into three. Interest income. This is obviously putting that money together. You'll have a fund manager invests into various investments such as bonds, fixed deposits, and money market instruments that will generate interest income over time, and obviously it gets paid out. That's one way of looking at it. You can also invest into dividend income. So you're holding shares or equity-related investments such as real estate trust, or what we call REITs. They'll distribute some of their profits out to shareholders in the form of dividends, and obviously the unit trust will collect those dividend payments and distribute it to you. Okay, and then obviously the other big thing is capital growth. You buy into something now, and a few months later, it's a higher price from your initial price. That's what we call capital growth or capital gains. Okay, so that's a very, very simple way of looking at it, but this is what unit trust can offer you. So what I've done quickly here, just to give you an example, on our website, these are some fun fact sheets. These are just looking at some of the PSG funds. These are income orientated ones. He has diversified income, and he has the money market fund. I suggest you can see at my cursor at the bottom here, the highlight. You can go onto our website and you can look at all the different funds. Right mouse click on the fund name. It brings up a fund fact sheet. What's important, you can see this little box I find very useful, especially for the PSG funds. It'll highlight you where the risk return ratio is. You can see a little dot there. You see these are all very, very low risk funds. So, but if you're looking for interest income, it also explains to you the income every month, etc. Okay. And also going one step further, on our website, you have a tool called Funds A to Z. You can see in the bottom left here, I've highlighted where you can find it. It's a tool where you can compare different funds. So I've taken all those funds we compared in the previous slide, and you can see, you can look at the performances, you can look at the fees, and you can look at the risks. You can see here, just for the last year, comparing these four funds, you're talking about 8.8%. That's what income funds are giving you right now, interest funds are giving you about now. Okay. So if you're a bit more conservative, you want to preserve cash, or you've got an emergency fund, this is the kind of returns you're looking at. Remember, it's more shorter term, I believe. You don't want to have all your money in here for long term. Inflation is going to eat it up. And we start looking at capital growth. These are some of the funds, PSG funds again. You can see as the PSG equity fund, class E. You can see they're different classes. They're all the same class. What they call class E, they're the clean funds, clean class funds. There's no rebates in that. And most funds are moving towards that, just to simplify it. Again, look at where that dot is in relative to risk and return. It's right up top there. Okay. That's slightly bit lower risk, that's slightly lower risk, that's up top there. But now you can compare again all these different funds, and you can see this, for example, the Global Equity Feeder Fund, much higher returns, or the growth as such over the last year. Because on average, I was at about 15%, so much higher than you're getting the interest. So just understand the stuff when you're doing your homework and that. Talking about it, how do you choose your funds? First of all, I suggest you look at the two ways of contributing towards a unit trust. So you can have what we call monthly recurring contributions, or we call debit orders. I find this is a great way for a disciplined investment approach. If you're investing 500 Rand monthly, doesn't matter what's happening in the market's going up, the market's going down, you're consistently investing your 500 Rand. So it's not timing your market, it's time in the market. I think that's what's important there. And number one, and number two, is that obviously you're committing yourself to that monthly debit order every month. So irrespective of, as I say, what's happening with the market conditions. So if you're also investing on a monthly basis, you're taking on advantage of what we call rand cost averaging, or it is you just by investing a fixed amount regularly, you're purchasing more units when prices are low, because remember the market goes up and down. So you're buying more units when the prices are low, and less or fewer units when the price is high. But the main idea here with rand cost averaging is to help smooth out the impact of short-term volatility over the long term. So your cost should be much lower over the long term. Okay. Very importantly, also affordability and flexibility. You know, when you're first starting out, putting 500 rand a month away, and then as your financial situation improve, you can increase that monthly contributions in it. But it's affordable. That's number one. It's also flexible in the sense that you can stop and start. You know, this month's a bit tight. You can stop your debit order, for example, and stop and start and goes on. It gives you that flexibility. And also what's so important is, as I mentioned just now, is investing regularly over investing regularly, but over a long term. Obviously, you're reducing the risk associated with trying to time the market. Yeah. So instead of speculating on the right market entry point, you just allow yourself to take advantage of the long term by using this recurring premium. Lump sum, some of you might decide to go with lump sum. The bigger idea here, you've got a substantial amount of money, you're going to the market at the right time, at once. So yes, you're deploying all those funds straight away. So yes, it is more of a simplified approach in the sense that yeah, it requires a one-time investment decision. So it's obviously it's convenient for those who prefer a hands-off approach to investing. Some of you might have what we call an ad hoc approach. You know, as you get additional funds coming in, you might have a regular recurring debit order, but also you might get extra money, be it a bonus or inheritance. You can also put it in. So it is flexible. Let's move on to, and this is what I want to spend some time on, how to pick a winning unit trusts. So what's important, I have touched on it before, your investment goals, very, very important. Okay, so define your goals. What do you want? You know, is it a new house, car, holiday? Is it just wealth creation? Whatever is important, but have it in mind first of all. You can also label, name your investment, your voluntary investment plan. Call it a car investment or whatever the case might be. Okay, so that bigger picture, having that bigger picture, I find it so much important. You know, a bigger view or picture, or how much wealth one wishes to accumulate, and for what duration is important. So all those kind of things it gives you a bit more, how can I say, a starting point for you to choose your funds in it. Okay, so we got over 450 funds on our platform. So you need to find the funds that will meet your goals. And that's where it all starts. So it helps you narrow down the field, we'll put it that way. So what's also important is to look at your risk. So there's two things we talk about. We talk about risk tolerance. First of all, we talk about risk capacity. How much risk can you take on? Okay. Well, it's really quite, I call it risk profiling. So first of all, it's your risk tolerance, and then risk capacity. Knowing the amount of risk can also obviously help you a lot. Risk tolerance, you know, can you tolerate the market volatility, the ups and downs? Are you a bit more conservative, etc.? And then again, your time horizon is very important. I have mentioned this before. The longer your time horizon, the more risk you can take on. So remember, the risk and return work together. So historically, the stock market is giving you 10%. If the market does pull back, give yourself time for the market to recover. Okay, if you find that it's too much for you, you might have a bit more moderate approach. Rather go for a balanced portfolio, what we call balanced unit trust. Say 75% maximum exposure to the share market, but you'll have more exposure to property and money markets, etc. Okay, so there's a lot of information here, step by step, as I say, self-explanatory. The main idea I wanted to highlight with this slide was, you know, look for experienced, disciplined management team. PSG has won many Raging Bull Awards. That's a website you can go to, ragingbulllawards.co.za, and look at past winners and things like in all the different categories. But and again, when I highlight for you, that the whole idea is to build a diversified investment portfolio. Okay, understand your benchmark. You know, the whole idea here is to know what you should compare it against, to know if your portfolio manager is doing his job. You know, if it's inflation plus 2, is he doing that? Is he meeting that criteria? Okay. Um, and then also, consider fees. We have mentioned this also before, where PSG funds, our monthly admin fees are much lower. Obviously, there's incentive for you to invest with PSG funds, but it might be 2 or 3, 20 basis points, but over the long term, it does compound and does add up. Okay, so be aware of those things. Consider diversifying international funds. So we've got some very good international funds on our platform. Take advantage of that. Then I want to highlight for you uh, ETFs. I like ETFs. There's a lot of advantages with them. In this context, we're talking about starting a share portfolio, investing in ETFs instead of unit trust. Let's look at ETFs. Very similar. Big difference between the two of them. Unit trusts are valued once a day, and ETFs are the prices are trade like shares. So you can buy and sell them whatever the market price is at that point in time. But there's a whole lot of different asset classes you can be exposed to. You can be involved in shares, bonds, commodities, currencies. There's a whole lot, and also obviously offshore. Um, the fees are much lower, much more, a lot more liquidity and things like that. The most popular or most best known ETFs obviously is the SATX 40. That's top, giving you exposure to the top 40 large cap stocks. It's interesting to note that SATX 40 has been nominated or has won for 6 years in a row the most favorite ETF on the market. Okay, so that's the biggest one. You can see there's a whole lot of, there's 10 of them. At the bottom here, you can see the source where I got the information from. Okay. What's important also when it comes to a share portfolio is to different styles. Either this is building a share portfolio now, you can be a value investor, what I call the Warren Buffett approach, or bargain hunting. All you're basically doing is you're looking for shares trading below what we call the intrinsic value or the net asset value. So as I said, you're bargain hunting, you're buying a share at 5 Rand, it's actually worth 10 Rand, and you sit and wait for the market to realize that the share is undervalued and the price goes up. So we use a lot of financial analysis, a lot of things like P ratios and big ratios and NAVs to help us determine if the share is cheap. Okay, never buy a share on price. A 50-cent share can be cheap, it can be expensive relative to its profits, where a 500 Rand share can be very cheap relative to its profits. Okay, so as I say, what we call bargain hunting, that's what we call value investing. And there are a lot of shares in the market right now offering you opportunities like that. Growth investing, this is going for more of the smaller or emerging companies. They're expanding rapidly. But there was obviously risks involved here. Many years ago, MTN was expanding into Africa. It was a growth stock. It wasn't paying out any dividends. That's also very important to understand with growth stocks. They reinvest all those dividends back into the business for future growth. Okay. The big, if you look at offshore, the big buzzword right now is AI, and there's a company called NVIDIA. Everybody's flying into that company as a growth company. It's not cheap from a PE ratio. When I say PE ratio, it's price earnings multiple. I think NVIDIA is over 200 PE. It's going to take you over 200 years to recover the current earnings, profits out of the current share price. Would you prefer 200 years or 5 years? So obviously the lower the PE, the better. And then another style of investing is investing for dividend income. I've touched on this before. This is where you buy into companies that are, might have a high dividend yield. The average of the market is about 3%. You're looking 5% plus. But you're also looking for a company that consistently pays out dividend. It doesn't matter what's happening in the market. Okay, and then the whole idea is to determine all these different styles, how that fits into your portfolio. Okay. So a quick summary, guys. I know I've gone through this very quickly. I know that sometimes I overstep it, but we've gone through those 10 reasons why women should feel more confident, and good reasons for that. And I think men can look at exactly the same reasons for that. Men can learn from women about investing, have goals in mind, have something tangible, diverse portfolios, balanced portfolio, etc. So we're not so much cowboy, we're a bit more balanced. And then obviously those investment strategy I was talking about just now. So just before we hit on to the questions, should I highlight for you quickly? I don't think I highlight, yeah. The whole idea here is that there are a lot of information out there. These are some books I came across, recommended. You can go to this website here, I can't remember who it was. FEMA money. But you can see a smart money. These are quite books you can start as a suggestion. Go look at it, and then this lady also wrote about these different books. She gave her some critique. Okay, so he obviously likes Bach, David Bach. He's got 2 books on this list. You also go look at some websites for women. These are more international. Okay, and then lastly, I also came across some financial blogs here in South Africa. What might also be very interesting. There you can click the link at the bottom. Okay. So guys, there are obviously various investment vehicles for you to achieve these goals. There's links to those, what we call key information documents. As I said, the webinar recording should be out tomorrow or by Friday. Cool. Let me see what kind of questions you guys have. We'll take it from there. Cool. Question you have from Sharon. Daniel wants to know, can I invest into ETFs through my tax-free investment account with PSG? Sharon, no, we don't offer ETFs in our tax-free. The underlying investments into unit trust at this stage. We are contemplating adding into the ETFs a bit later. I suggest maybe you're looking at ETFs, especially in the tax-free. There's a website I suggest you consider maybe looking at ETFSA. They've got over 200 ETFs on the website. And you can start there, it's 300 Rand, 300 Rand per month. Okay. So yeah, good website to look at, especially with ETFs. I hope it answers your question, Sharon. Here's a question from Jan. What's a minimum to invest in a local share portfolio? Okay, I always have this question. Okay. Jan, there's no minimum, but obviously you need to consider the trading costs. Our minimum trading cost is 230 Rand. So, for example, you want to put 1,000 Rand in, you must understand your share has to move of 23% to break even on costs. So, I would suggest at least 20,000 Rand, and with that 20,000 Rand, I'd consider a ETF and build an ETF portfolio. Through one share, you're buying into a basket. You want to minimize risk. Ideally, I would suggest at least 100,000. You can buy 5 different companies, 20,000 each, and then build a diversified portfolio as a starting point. So, Jan, I hope that answers your question too. Let me see, are there any other questions? Okay. Well, guys, I hope it helped you. Got any other questions? You're welcome to contact me. You can contact me on the wealth at psg.co.za, the wealth box. You can also contact me on what we call OneStream 0860 000 368. Okay. Well, guys, until next month, our third last month of the year, it's September. Looking forward to it. Until then, bye for now. All the best.